Hey everyone, welcome back to Corporate Decoder. Future Vision 2 Acquisition Corp. FVNNR just filed a Form 8K detailing an extension of their business combination deadline, and I am seeing a move that hints at a challenging path ahead. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company has secured more time to find a merger partner, but the terms of this extension reveal some interesting pressures. Let's dive into what is happening. Future Vision 2 Acquisition Corp is a special purpose acquisition company, or SPAC. Think of them as a company formed specifically to raise money through an initial public offering, or IPO, to acquire an existing company. Their main goal is to find a private company and merge with it, effectively taking that private company public. They are always on a deadline to do this. Originally, they had until the 13th of July 2026 to find a suitable merger. Now, thanks to an extension pushed by their sponsor, Way Superspeed Company Limited, they have until the 13th of August 2026. That is an extra month. This extension was approved after the sponsor provided some funding. Specifically, on the 8th of July 2026, the company received a promissory note for about $191,475 from its sponsor. This money goes into the company's trust account, which is meant to hold the funds raised from the IPO until a business combination is completed. This note helps the company extend its deadline. Now, here is where it gets interesting. This promissory note doesn't carry any interest. That is good for the company. But it matures when the company either closes its business combination or doesn't. If they don't find a deal, the note is forgiven. This means the sponsor isn't really risking their cash. They are in essence getting an option to extend the company's life in exchange for future potential gains if a merger happens. Even more revealing is that the sponsor can choose to convert this loan into company units at a price of $10 per unit if a business combination is completed. These units are the same kind that were sold in the company's IPO. This gives the sponsor a way to get more equity if things go well, at an IPO level valuation. However, the current market price for these units is far below $10. For example, the rights, which are part of the units, are trading at around $0.18 as of my last check. This suggests that if the sponsor converts this note, they are getting a much better deal than public investors are currently seeing. This is a common SPAC tactic. Sponsors often inject cash to get extensions and position themselves for favorable conversion terms. The fact that they are extending the deadline on the 8th of July and formally reporting it on the 13th of July hints that they might be struggling to find a suitable merger target within the original timeframe. They are currently pursuing a business combination with Microtouch Technology Inc. The merger agreement was dated the 16th of January 2026. However, the filing explicitly states there is no guarantee that a business combination will be consummated by the 13th of August 2026. This is a significant risk that shareholders need to be aware of. When SPACs go past their initial deadline without a merger, it often leads to a liquidation of the trust account. This means shareholders get their initial investment back, usually around $10 per share, and the company essentially dissolves. Receiving an extension from the sponsor typically means the sponsor believes there is a reasonable chance for a deal. But it also points to the difficulty in finding one. For Future Vision 2 Acquisition Corp, the current market price for its units is significantly below the $10 IPO price, which makes it even harder to find a target company that wants to merge at that valuation. What we have here is a company trying to buy more time, but the terms of that extension might indicate just how challenging their search for a merger partner has been. The sponsor is essentially giving them a lifeline, but the conversion terms of the loan suggest they are betting on a future rebound or a very favorable deal structure. Given that many SPACs struggle to find targets and end up liquidating, this extension is a double-edged sword. It buys time, but it also highlights the current difficulties. I am looking at two key things here. First, the sponsor's willingness to extend. Second, the potential for the sponsor to convert the note into equity at a significantly higher price than the current market value. This could lead to further dilution for existing shareholders if a deal is eventually struck. The risk of liquidation for Future Vision 2 Acquisition Corp remains a live one. My biggest concern is the ongoing struggle to find a suitable business combination, as evidenced by the need for this extension. Looking at the research here, Future Vision 2 rights FVNNR are trading very low with a 52-week range from $0.11 to $0.23 and currently sitting around $0.18. This is a fraction of the $10 IPO price. This price action suggests a lack of confidence from the market in the company's ability to complete a deal at a valuation that would satisfy current shareholders and the company's aspirations. The extended deadline buys them a little more time, but it does not fundamentally change the challenging market environment for SPACs or their ability to find a compelling acquisition target. What I'm actually looking for is clear evidence of a viable merger candidate that offers a path to value creation for shareholders. Without that, this extension is just a delaying tactic before potential liquidation. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord.